Sunday, September 17th, 2017. Monaco 64 here. I want to talk about the price of money, which is interest rate. And usually interest rates are, derived from bond prices, because bond prices are basically loans which are, lending money. So it's the cost of money. And there are different kind of bonds. You have very short-term bonds, or they call them T-bills in the US. 1-month T-bills, 3-month T-bills, 6-month T-bills, 1-year T-bills, and then it goes up to 2-year notes, 5-year notes, 10-year notes, then 30-year bond. In the UK, there are also T-bills, but then it goes to, they call them gilts instead of notes or treasuries. And basically, historically, the price of money in the US and the UK, let's say for the government to borrow money over 10 years for a 10-year bond or note, has been like between 5 and 6%, 5 and 6% if you go back 200, 300 years. But ever since the 2008 crisis, these rates have dropped to historic lows. In some countries, they're even negative. In Germany, it's less than 1%. In the UK now, the 10-year gilt is just above 1%. In the US, the 10-year note, the yield is 2.2%. And that's in spite of the West, especially the US, the UK, and many other countries in the West, having huge national debts and huge unfunded liabilities, which cannot be paid at all unless there's a default or unless they really trash the currency, in which case everyone loses out. The general population loses out because the purchasing power of their money goes down, or their currency. Their wages will be worthless. Only the very rich who have hard assets and properties, or who have a lot of assets, can protect themselves against that. And why am I talking about the interest rate? Well, because the bond markets have been in a bull market since 1981, when the 10-year yield in the US actually reached just around 16%. And though that yield has been dropping ever since. And ever since then, we've had, financialization. The bond markets have been getting bigger and bigger. Credit has been getting bigger. The debt has been getting bigger. And it's this low interest rate, scenario and also situation, that the central banks in the last 8-9 years, they've been printing money to buy, government bonds to keep interest rates low. That has spurred the credit boom, the debt bubble. It's only because money has been readily available, and big debtors like central banks and even consumers and corporations, they've been able to just roll over that debt. They haven't been paying them off. They've just been rolling over at lower rates, and they've been backing it by higher and higher financial asset prices. And that is the biggest bubble of all. Right now, for example, in the UK, this week, there was the central bank meeting, Bank of England, and they actually warned that they might start raising rates because, the CPI number got up to 2.9%, and that's above their target of 2.5%. So gilt yields, the 10-year yield, basically spiked, as you can see in this chart, from around 1% about 10 days or a week or so ago, now to 130. But you can see that historically it's still really low. I mean, in 2014 we got up to just probably around almost 3% there. So we're still historically low. And as I spoke earlier, going back 200, 300 years, that rate the average is around 5-6%. And apart from the CPI number that was 2.9%, there's also an RPI number that is more like 4%. And that includes, mortgage payments, that includes council tax, things that are really important to the cost of living. So really the UK gilt yield should be more like 5-6%. But we've heard it all before. This is not the first time that the target CPI has been, above the target. Even before Mark Carney, Mervyn King kept, rates low with inflation, near 3.5%, and gilt yields have continued to go down. So am I saying that we're now, gilt yields and that treasury yields are going to explode? No. But I think we need to keep an eye on that, and because that's the most important thing for financial markets, because it's the price of money. So I'm not trying to scare people and say, oh, this is it, because, this bond bubble has been going on for, almost, 36 years now. And even though the low in the 10-year yield in the US was last July, at around 1.32% yield. So right now, as you can see, the 10-year yield almost got back to like 2% recently, but we're now back up to 2.2. It wasn't only the gilt UK yield that spiked last week, because many people probably think, oh, it was only the UK because the Bank of England was hawkish. But as you can see, the 10-year yield has spiked recently. We're still very far away from historic levels, of course. The key resistance on the upside is around 260, as you can see there. The high late last year and the high earlier this year in March. And if you go and look at Japan, Japan has 200% or more of debt to GDP, their national debt. But as you can see recently, in the beginning of September, the JGB 10-year yield got below 0, minus 1 basis point. And now it's at a measly 3 basis points or 2.9 basis points, which is crazy. I mean, go figure it. And also the German Bund 10-year. I know Germany doesn't have as much debt as most of the Western countries. Their government is not as profligate, but they still have a lot of that. And their 10-year Bund yield is at 0.43%. Recently, it got up to 0.6 a few months ago. But as you can see, that also rose quite a bit last week, from around 0.3 to 0.433. I remember, back in the 90s, the Bund yield was around 5-6%. This is not normal. And I just wanted to show you another little, not chart, but it just shows you where all the central bank rates are right now. And you can see that the Fed is 1.25%, ECB 0, Bank of England 0.25%, Swiss National Bank negative 0.75%, Reserve Bank of Australia 1.5%, Bank of Canada 1%, New Zealand Central Bank 1.75%, Bank of Japan minus 0.1%, and then you can, if you look, at the Russian Central Bank CBR and the Indian Central Bank RBI, the Chinese PBOC, and the Brazilian, they're all like at fairly normal to high rates. The Indian Central Bank 6%, that's where you'd expect the UK rate to be. People's Bank of China 4.35%. I'd say that's fairly low, but a lot higher than 1.3 or the 0.25 like the Bank of England has, and the Brazilian Central Bank 8.25. So those rates are more like market rates, even though those countries are considered BRIC countries, or they're like not, and they're less developed or emerging markets. I would say their rates reflect more reality than the rates, you know, in the West. So yeah, we need to keep an eye on those interest rates, even though, you know, you can search in my YouTube channel for bond market, bear market, bull market, bond bubble, and you find loads of videos I've done about bonds because I used to trade bonds for my clients. So that was the core of my business, interest rates and bond markets. My feeling is that it could happen overnight. Central banks, you know, the markets and investors could lose complete confidence in central banks, because the only reason these interest rates are where they are is because central banks are printing money to buy the bonds. And when you buy the bonds, you drive the yields down. That's how bonds work. The higher the bond price, the lower the yield. And investors and speculators, they've been, you know, assured for the last 8-9 years by central banks that they can buy as many bonds as they want, you know, government bonds, because they're going to have their back. And it's gone from government bonds to, you know, better quality corporate bonds, lower quality, and to junk. So all these interest rates are, you know, people are searching for yields, and they're, how can I say, artificially low. How long will that last? I don't know. But my feeling is that it won't be an orderly retreat. I don't think we're going to see an orderly and gradual increase in interest rates, only because the markets are so leveraged. There's so many, you know, hedge funds. There's so much. And the other thing as well is that rates are so low that in order to get a good income from trading or in investing, investors, speculators, central banks, they have to leverage themselves so much. Because, you know, if you're earning 0.4% for 10-year money in Germany, you know, that's not going to cut it. So you need to leverage, you know, your balance sheet in order to make that 0.4% more like 4%. And how do you do that? You leverage 10 times over. So that's why I'm saying once it turns, it could be a rush out of the, you know, theater. You know, it could be like, you know, trying to rush out of a movie theater when there's a fire. It's going to be ugly. When it's going to happen, I don't know. Was last week, you know, the start of it? I don't know, but we need to keep an eye on it. So that's it for now. Just wanted to talk about the bond markets and what interest rates have done. If you enjoyed this video, please like, share it, and also subscribe to my channel if you haven't yet. And I'll talk to you later. Bye.